Hey everyone, hi Michelle. How you doing?
I'm doing well. How are you doing?
I'm doing fantastic, and good to see you as always today. What do we have on the docket? Did anything get sent in, or is anyone saying something in the forum that we want to talk about?
Um, I I didn't get any questions sent over this week, which is kind of a good sign. I guess we're getting some things cleared up. Um, do you want to just run us through what's been going on in the last little bit in the market?
Sure. Sure. So today was Fed announcement day, so that's always a exciting time in the market to kind of see what's going on. I don't think we heard anything new from what we've necessarily been thinking, but let's talk about what we've been talking about for a while, and let's kind of talk about where the setup is. So in general, we're just going to go generalities, and then I'll probably pull up maybe a graph or so just to kind of look at where kind of the data points are. So in general, right now we've got a inflationary recession that has happened and is kind of like going on right now, albeit so far it's been a mild one. And I say mild, but I know certain stocks are down 30% or so. So small caps are definitely getting hammered. So yeah, mild, but still it's a recession, right? Then you've got interest rates are starting to slow down as far as their interest rate hikes, if not stopped. So we have them projected to be stopped right now, and then even here in a little while, actually, they'll start cutting rates. And then let's see, inflation's coming down pretty aggressively, so that's kind of the whole deal. One thing that I'll say right now is that there are two different types of recessions. And I think everyone kind of feels like most of the time they're just recessions and they kind of play out in certain ways. So, like 2008 recession, 2021 recession, pretty much every recession since the 70s has been deflationary recessions. And deflationary recessions play out like, let's just kind of say that they play out like the Fed, the central bank, and in general, the bond market pulls uh, bond yields and risk yields down as deflation kicks in, which is stimulative for the economy and it's inflationary for the economy. So it kind of pumps everything up, right? And it kind of offsets the contraction in the deflation. The opposite is true in an inflationary recession. Basically, an inflationary recession is as inflation goes up, right, and is too high, bond yields and the Fed all come up to match, and to deal with that, which is restrictive and slows the economy down and inevitably puts a recession in place. So the recession comes in two different ways, right? One is the recession comes in the deflationary one by the deflation itself, right? Which means it ends with the inflation turning around. The latter of the two starts with high inflation, right? And rising high inflation with tightening monetary policy, right? And then as inflation cools off and comes back down, that normally signifies the end of the tightening cycle or that recession or that collapse. Because what inevitably drove the recession in the first place is actually starting to fade. And that's typically what happens now. In the 70s, we had a lot of on, off, on, off. And we'll get the same thing again, even though the Fed doesn't want to, but that's just what they do, right? So what inevitably will happen is we'll have we'll have another cycle of inflation that comes through, and then we'll tighten again, and then this will all happen again, and that'll most likely be a lot more of the types of recessions that we'll have from this point on. Maybe for the next couple decades or so. We're in a new regime. So the types of recessions that we had over the last 30 years are definitely not going to be the same types of recessions we're going to have from this point on. So let's put some data down though. Let's just so we can kind of see what I'm talking about. Here, let me present something. Share screen. We'll present a tab. So here. So I've got three lines on this graph here, and I'm just showing here. Let me just hide this over here. So I've got three lines on this graph. And one is the Federal Reserve balance sheet. So that's the blue one. And then we've got the light blue right here, the teal, I should say, is inflation. And then we've got the effective federal funds rate. So kind of imagine that there are two pedals that the Federal Reserve has. It used to only be one. Now we have two. And then there's actually a third one, but that involves the government. We'll deal with that in just a second. So the Fed basically can push down the gas and drop interest rates. So every time that they drop interest rates, imagine that like slamming on the gas and taking a car that is, say, slowing down, and it's punching the gas. Now there's a delay, right? There's a little bit of delay from when you punch the gas to when you actually feel the acceleration. And then there's even a delay for the car to start to get up to speed, right? So it takes a little bit, so imagine a car that's hard braking. You take it off the brake and slam it on the gas. There's that shift, there's the delay, and then there you go, right? So that's one pedal. There's also a second, like, let's call it like level 2, right? So you got half throttle, which is interest rates. Then you got like 3/4 throttle, which is a lot more throttle, which is quantitative easing, right? And quantitative easing is basically when you have the Federal Reserve's balance sheet growing because they're buying assets, right? And that is also stimulative. So that's like hitting the gas pedal even harder. Then you've actually got one more step. I don't have it on here, but then you have what's called monetization of debt, right? So basically what that starts to do is the government, right, the central or whatever government of the country is, they start borrowing money, right? And when they start borrowing money, now they can do one of two things, right? They can borrow money from other countries and then just give it, and just send it out into the economy, give it to businesses, give it to business loans, small business loans, large business loans, whatever, right? Debt restructuring, all sorts of different things like that. They can do all sorts of stuff like that. That is also very stimulative because it's new money that wasn't existing in that country that's coming in. Or you can do debt monetization, which is where you borrow money in essence from the central bank, right? So the central bank prints money into existence, buys government bonds, and then now the government goes and spends that into existence, right? So that's kind of the third pedal, right? So that's hardcore, everything you got. That is exactly what happened in COVID back here, right? By the way, that was all three pedals hit to the floor, going nonstop. That's why it was so aggressively a turnaround, right? Because we basically stopped the economy. The car came down to a complete stop and we floored it. So just to kind of give a nice recap of kind of the things that we're having in play. Now, COVID was deflationary, probably the last deflationary recession we'll see in a while. And now we have an inflationary recession, and that comes at the back of, putting too much money into the economy and to the regular Joe Schmo. So what ends up happening is now inflation's too high. So that's this teal line back here. And the Fed needs to do something about it. So this Fed, every Fed's a little bit different because they make decisions a little bit differently. They always kind of, do something a little bit different. This Fed is typically behind the curve, very much behind the curve. In fact, they probably should be dropping interest rates right now, but I digress. So anyways, this Fed is behind the curve. So what happened was inflation soared way above their targets. So over here on the left side here is their targets. Their targets are 2%, right? They passed 2% and they were still printing money, right? They were still growing their balance sheet. They still kept interest rates near zero. They were dosing the economy, and it's no wonder why inflation shot way over what they were expecting, right? So boom, of course, we all knew that it was going to happen, or at least we talked about that inflation was going to be out of control. Anyways, so it started getting up there. Then they were like, okay, this has gone too far. So they started to slow it down, right? So this is them slowing it down. So they're slowing it down and eventually stop. They raise interest rates and start to tighten their balance sheet, right? Very aggressive turnaround. Now they're hitting the brakes and they're hitting them pretty hard. Now they're accelerating the amount of interest rate hikes and they're tightening. Then what's happened lately, right? Just to kind of zoom into where we are, inflation is dropping very aggressively, very quick, which is stimulative, right? That's very stimulative for the economy, because in turn, bond yields, borrowing costs, and everything should now start to drop down. They should cool off, right? And as that cools off, it's stimulative for business growth, right? So now they're still tightening their balance sheet, but we've had a few banks blow up. We've had a few things go up. That normally happens in a tightening cycle, especially near the end of it. So now the balance sheet is growing again, not for the reason of quantitative easing, but neither did it in 2019, right? This was the repo market that was blowing up in 2019, and that was not quantitative easing as well. It doesn't matter. It's still new money coming into the system, right? So what we have here is new money coming into the system, no matter how you cut it, right? New money came in, and it came in like a quick dose too, right? But we have the federal funds rate still going up, right? But you can see here, you see this curvature is starting to slow down. Soon, what we're going to see is a pause, and then maybe even a drop. Maybe the market is pricing in around July that we'll see our first interest rate cut. So if that's the case, then that would mean inflation would be cooling off pretty dramatically. Right now, we're roughly around 5%, just under 5% for inflation. My targets have us just underneath 4% over the next couple months. And then we get all the way down into the threes like third quarter or so. So that would mean that, wherever tightening is at needs to actually pull back a little bit, because the amount of tightening that we have can actually slam us into a deflationary spiral if they continue to stay as tight as they are. So that's going to be the catalyst for the next business cycle growth, and that's basically what we have right now. So that's where we're at. So we actually have a lot of bullish things coming into play right now. Everything's starting to turn around, and I know a lot of my models are actually, especially after today, are starting to actually kick in, saying that we're actually going to have a little bit of a resurgent, like a phoenix coming out of its rebirth. It's going to start kind of picking everything up, and everything's going to go really smoothly there for a little while. Now, we do have some kind of like lingering effects though, right? We still have banks tightening as far as going into their individual lending, is small business lending and things like that. So there is still a little bit of tightening going on, right? And then we also did have a one more tightening right now. And like I said, I think the central bank is maybe a little bit over tightened right now. So we could get kind of this knee-jerk collapse over this quarter. That's very, very possible. If we do have this knee-jerk collapse, it'll be the last one, right? After this, it'll be all holds barred, straight up. Will be very stimulative and things like that. So this is really kind of the last quarter. If there's really much risk to the downside, this is kind of the last quarter. So that's kind of where we see things as far as the model goes, as far as macros go, all good things.
I think that's super. It's handy to see it all in one chart. That's great.
Right? It is kind of nice to see kind of where everything goes. I mean, these are the three primary, contributors to the market. I mean, I can even go back to this. It's like here's 2008, right? So this is a deflationary recession, right, Michelle? And it acts like what I was trying to say, right? The deflation is going to kick in, right? And we know that it's coming, right? Even though this is a year over year number, month over month, we know that deflation's kicking in. The market's rolling over. We're having some issues in 2007, right? So what does the central bank do? They start dropping interest rates, right? And that's kind of the first step, right? They start dropping interest rates to kind of stimulate things. And then they have to eventually right here, this initial explosion was them definitely printing money, giving it to the banks, and blowing up their balance sheet, and eventually did quantitative easing where they started buying mortgage-backed securities and stuff like that. And you can see here, like from the time of 2009 to May of 2010, the market was very strong to the upside. We had a correction in the market at the same time that the Federal Reserve stopped printing money. And then the market blew up again along with the Fed balance sheet. And then, hey, guess what? In July, we had the debt crisis, right when they stopped quantitative easing again. And then, hey, guess what? At the end of 2012, we had like one of the strongest rallies in history. Guess what? That was growing Fed balance sheet. And then 2015, right here, we had a very aggressive, contraction in small caps and a little bit in large caps. And then finally, the market kind of started growing on its own right here. And we started tightening. So anyways, it's kind of fun to see the balance or the Fed, the Fed and kind of how they work. And this is, like I said, this is a deflationary recession. And then now we have an inflationary recession. COVID was a deflationary recession as well. So you can see they drop interest rates first. The deflation's coming in. We know it's coming in, right? But they drop interest rates first, stimulate, print money, dose everything up, and create inflation, right? This is the opposite, where now they're tightening, raising interest rates to stop the inflation, and that inevitably pushes the economy down. Something that kind of helps is if I put something like the SPX on here or the Dow, right? You can kind of see how this all kind of plays out, right? So you can see inflation starts to get too high, everything's too hot. They start to slow down their interest or their quantitative easing. And so as soon as that starts to slow down, everyone knows the credit crunch is coming, right? That's the first step in an inflationary recession. Inflation's too high and the Fed's starting to act. That happened literally like December, right? I mean, we knew it was coming. Everyone knew it was coming. We were talking about this before it even happened. Anyways, you can see old videos of that. But anyways, so then the credit crunch happens, boom, assets start dropping, everything starts to have a hard time. Sometimes it's easier to see in more growth sensitive stocks. This is, we can put in we'll just put in the RUT. So these are much more growth sensitive stocks. So you can see that same time and same aspect, right? The growth kick was starting to kind of slow down. Boom, they tighten up, and you can see there's a very, very aggressive collapse as the Fed started the acceleration of tightening, right? And then you can see here now, albeit they're still at their lows, right? You know, the small caps are down 28% right now, so they're doing pretty rough. Yes, the S&P is only down 13, but anyways, so they're down there at their lows, right around where a regular PE ratio would have them actually. Anyways, pulled back, and then as soon as this starts to kind of roll over, turn around, or this starts to accelerate, and this starts to come, the inflation starts to come down, that's that kind of stimulative factor. So we really should start to see Russell up, S&P up, maybe even some tech companies. I don't think it's going to be something stupid like profitless tech companies going straight to the moon again. That doesn't make any sense. But, or crypto going to the moon or something like that. I mean, except for the debasement of the currency, we won't get into that. So anyways, long story short, I went on a little tangent there, but hopefully that kind of explains where we are in the macro cycle, what we expect going forward. We can always still be a little bit wrong in the short term, right? The market can come down, the market can, skyrocket to the upside. For right now, it's a little bit more neutral as far as risk goes, but it is shifting from actually being a rather bearish case to now being a decently significantly bullish case for the remainder of the year, and until the next inflation cycle kind of kicks in. So that would probably be, I'm thinking mid next year or something like that. I know I'm kind of forecasting a little bit, so it's, who knows, but yeah.
Sounds great. All right. If you guys have any questions, email me for next week, and we will see you then.
Awesome. Well, thanks everyone. Michelle, always good talking with you, and we will see you next week.
Talk to you soon.